We have more for your ears only. I'm Catherine Herzog.
I'm David Alpern with this quote from the news. An agenda to attack the Second Amendment. That's how the NRA described Vice President Biden's mission to find consensus on reducing gun violence. At one point, Biden did suggest that President Obama could take executive actions independent of Congress, but the expectation was he would press less hard for another controversial assault weapons ban than for better background checks, tighter controls on ammunition and high-capacity magazines, more mental health support. Now this.
So we're taking on some of the very specific problems that we know helped create the financial crisis. First of all, no-doc loans, where the lender didn't even pay attention or ask for any documentation from the borrower.
There were major developments last week in the continuing mortgage mess that helped trigger the financial crisis from which so many Americans and much of the world are still trying to recover. On the PBS NewsHour, Consumer Financial Protection Bureau Director Richard Cordray explained new rules for more transparent and less abusive mortgage lending going forward. Earlier in the week, 10 major banks settled claims of past mortgage abuse with $8.5 billion in cash and ongoing assistance for those who suffered from or are still fighting unfair foreclosures.
To consider those and related developments and the state of lending in general in America today, we're joined again by Kathleen Day of the Center for Responsible Lending in Washington. Welcome back to our program.
Thanks for having me back.
Let's start with that settlement over past mortgage abuse by major banks. $3.3 billion for past borrowers, as I understand it. $5.2 billion in mortgage assistance for those still fighting to keep their homes. How meaningful is that for actual individual families in each category?
Well, in aggregate, it's not going to make people whole. It's not going to undo the damage. Is it better than nothing? Yes. But the real news from that settlement is that it's the bank regulators recognizing they needed to scrap an earlier plan that they had which was so obviously flawed. It's remarkable that they thought it would work, but where they had basically told the banks, you hire consultants to go over your mortgages and see where you screwed up. So there was this inherent conflict of interest. The banks were paying consultants to review their work. So, and lo and behold, the consultants got lots of money, and no money was ending up going to the people who'd been harmed. So this is a recognition that didn't work. Scrap that. Let's at least get something out the door. Now the worry is, how will that money be spent, and how will they do that mortgage relief? Will they do it in a way that helps everybody, or will they do it in a way that the banks would have done anyway, and it's really no better than the old plan?
Is a larger message that criminal charges against top bankers are still out of the question?
No, these are separate tracks. These are bank regulators can't bring criminal charges anyway, but they can make referrals. But this is a scramble to try to say, whoa, this is so big, so bad, so many people were hurt. How can we at least try to help them? This is the regulators trying to catch up with the 50 state attorneys general who already settled when there was widespread fraud and misapplication of policy in mortgage servicing. So you remember the robo-signing? The 50 state attorneys general looked under the covers and saw that there was just massive shenanigans in the servicing industry. Then they settled, and the regulators hadn't done anything. This was their attempt to catch up.
Let's turn to the new lending rules and the requirements for what's called a qualified mortgage. What are the most important of those rules and regulations, requirements?
Well, people should remember, even before the rules, the main thrust of the new financial reforms when it comes to mortgages, it says nothing more radical than before a lender gives someone a mortgage, they have to assess that person's ability to repay it. It's called underwriting, and it's sort of finance 101. I mean, would either of you lend money to someone without assessing their ability to repay?
No, of course not.
Of course not. Well, so, I mean, that's sort of, it is remarkable. We had to codify that, is put into law what should be, common sense, but there it is. These new rules are a way to say, if you have loans that have certain characteristics, we'll deem that sort of the safest body of loans, and it will be presumed that, in fact, you followed the law and assessed a person's ability to repay. So even before these rules, you had to do this. These rules just give you some legal protection and some certainty about what your loan has to look like for the courts and regulators to assume that, in fact, you did what you're supposed to do.
Enforcement of the new rules seems to rely more on protection for following them than on punishment for not. Talk about the protection for lenders that comes with a qualified mortgage and whether that still leaves borrowers at a disadvantage.
Well, it does. If we could have waved a wand and had the world the way we would like it, we would have said the legal protection here would be that any borrower could still protest and go take the lender into a court of law, but the presumption would be, as long as the loan conformed to these characteristics, the presumption would be that the lender had followed the law, and the borrower would have to prove they didn't. But I give to the industry, frankly, 95 to 97% of all mortgages under this new rule, the borrower will not be able to challenge the lender. Now, that's not ideal in our book, but we can live with it because people may not understand. But 95 to 97% of all loans made, that pool of the market is not where the trouble was that caused this meltdown. We fought for and did get from the CFPB for the 3 to 5% of the market, which is the high-cost subprime market, which is where all the problems were. Borrowers do retain their right to take lenders to court if, in fact, they feel that they're being foreclosed on unfairly and the lenders, in fact, did not assess their ability to repay. So it is preserved for 3 to 5% of the market. That seems small, but what's very key about it, and I can't underscore this enough, is that is the market where all the problems were.
Let's look at some of the other issues addressed by the CRL's report on the state of lending in America after all the reforms generated by the mortgage debacle and the rippling financial crisis has caused. What's the bottom line?
Well, the bottom line is that there's been a lot of improvements, and we see that contrary to what some in industry have said, that common sense rules will make credit scarcer and more expensive. It just isn't true. However, in fact, the truth is it was lack of clear standards and lack of common sense rules that caused the crisis and caused credit to constrict. So, But what the thrust of the report is, there's still a ways to go. There's still a whole industry that engages in predatory lending and preys on people who are the least able to afford it. These are products that are designed, like payday lending or bank payday lending, that are designed to trap people in a cycle of debt where they have to keep taking the same loan out over and over and over. They're just on a treadmill of debt.
What's the situation with credit cards?
Credit cards are much better than they used to be. There were credit card reforms actually a year that Congress put in place a year before they even tackled financial reform because of the mortgage meltdown. They put in new rules for credit cards, and it was a bipartisan effort because everyone was mad at their credit card company. That was really there was wide consensus on that, and that was a place where it helped move the mortgage rules along because everyone saw, contrary to what some in industry had claimed, these common sense credit card rules didn't make credit scarcer or more expensive. In fact, it made pricing clearer. And when you have clearer pricing, you have more competition, you lower prices, you have more robust markets and more competition. It's just better. So that's what the credit card rules showed, and the reforms there.
Kathleen Day of the Center for Responsible Lending in Washington.
Quote from the news, "We don't know if the season has peaked yet." That was Dr. Joseph Bressi at the Centers for Disease Control on a new flu of epidemic proportions in many places and other winter contagions, including the worst national whooping cough outbreak in over half a century.
Next, technology tops and flops, the Consumer Electronics Show for your ears only.